Excuse me, you've just come out of the auction room. Did you buy a block of land?
Nope.
Why not?
Too expensive.
How much did you want to bid?
About 1,600, something like that.
And what were the prices of blocks this morning?
The last 15 or so blocks have started at 2,000 and gone up to anywhere between 3,000 and 4,000.
I mean, it's ridiculous to sort of pay such a lot of money for a block of land when you don't really own it anyway. I mean, you still pay $100 a year to rent the damn thing.
Australian house prices have risen faster than anywhere else in the world, according to a new report.
A study by Canadian company Scotiabank shows Australia has blitzed the rest of the world when it comes to property price increases for the September quarter.
According to the Global Housing and Mortgage Outlook report,
it still lists Australian homes as the third most expensive of 22 countries surveyed.
Booming property market has helped lift house prices to their biggest surge in 17 years.
No, housing is expensive, but prices in Australia are now rising at their fastest rate in 4 years.
What's everyone's thoughts on that? Who would like to have bought more property back in 1970? Yeah? What about in 2008 or 2009 after the GFC? Who would have liked to have bought then? Yeah? Maybe 2020, 2021 after COVID? Yep. So same story as you can see from that, guys. There's a trend that's happening there, and we're only predicting that prices are going to move in the same direction. So I'd like to thank you all for coming tonight. We've got a lot of people in the room, a lot of familiar faces, and I'm stoked that we've got a lot of support from our friends and colleagues, and a lot of new people who we haven't met before. So thank you for taking the time out on a Tuesday evening and coming to have a listen to us talk about property, and hopefully we can all learn something along the way. So a little bit about us, just for anyone who doesn't know. I'm Joel.
I'm Bianca.
This is Bianca. And we've been investing and developing property for a while now. Started buying property myself in 2012. And then I was actually working away in the mines for a lot of years. I bounced around up in North Queensland, around a few mine sites and construction, building railways and stuff, and then ended up over in WA, building railways over there and mine sites, working for them on rosters. And I actually really enjoyed it. It was a really good time, and one regret that I have is that I didn't buy more property, and I was on a really good wicket, and I bought 4 properties while I was working away, but I could have definitely doubled that if I knew back then what I know now. And so, yeah, come 2017, I was just in North Queensland, just doing week on, week off roster, and I met Bianca in 2016.
Yep.
And it was in 2017 that we really just dug in and just learned everything that we could about property investing and property development. And we've gone on to do buy and holds, renovates, flips, rooming house conversions, rooming house new builds, small lot subdivisions, duplexes, all sorts of stuff. And it was just recently, I'll let you talk about Echo Property.
Yeah. So obviously our background for ourselves, we started as investors and developers, but we launched Echo Property Group back in 2022 to help other investors that are wanting to get into the market. Perhaps you've got the same goals and aspirations to build a property portfolio, generate some good wealth for yourself, set yourself up for the future and for your family. And since we've helped over 100 investors build their portfolio, our office, we're just based in Maroochydore, and we've got an amazing team of 6 of us. So you would have met the team as coming in. We've got Simone, Sarah, Tash and Harrison here. So at the end of the night, if you've got any questions, obviously come see any one of us. We'll be able to point you in the right direction. But we're very, very grateful for each and every one of them. And yeah, we couldn't do what we do without our clients and our team. But yeah, we're really here tonight to obviously share our love for property, get it stuck into some data, really sexy, really, really sexy. But then just also dive into some of the different strategies that we're executing for our clients, for ourselves, and depending on what stage of your investing journey that you're at the moment, whether you're just starting out, perhaps you own your own home, perhaps you're a bit more established and you've got a few properties in your belt and you're wanting to scale a bit more, we're going to go through a few different strategies that might be exciting for you, depending on where you're at. So, over to you.
Cool. Cool. Oh, no. Alrighty, so we're going to do a quick market update, guys. We'll go into a few, like as Bianca said, go into a bit of data. I think it's probably important that we just cover that off. It does seem a bit boring at times, but we'll do it. Then we'll go into some investment strategies that we're utilising, like Bianca said, for ourselves and our clients. Some case studies, some stuff that we're currently doing right now and stuff that we've done previously, and then some Q&A. And I just wanted to just make it very clear, this is not financial advice, this is just talking about some strategies that we've used for ourselves and for our clients that has worked really well. Our belief is buy and hold. We love buying and holding property for the long term. We've managed to build a multi-million-dollar portfolio for ourselves now, and we've seen what it can really do for people's lives. And you know, us as a perfect case study. Since 2017, what we've learned, we've just managed to absolutely turn our lives, you know, around, and we're going in a completely different direction now. So property really does have the power to do that and change your life. So you can see here, this is, only little clicker's working, there we go. This is, guys, property prices from back in 1980. This is just an average property prices in Australia, and I just want to show you the power of, I guess, what holding property can do. So you look back in 1980s where that graph starts, and we're up at 2024 here. So the average property in Australia to buy back then was 60 grand, and you can see we've got some ebbs and flows, the ups and downs, and now, you know, 2024, the average price of property in Australia is nearly 900 grand. So if we have a look at that from a buy and hold perspective, if you've bought anything back any time before 2024, basically, you've made a ton of equity. But if you bought something back in 1990, you know, the equity that you've generated throughout that period is a substantial amount. And if you can get creative with your properties and get them to cash flow to a point where they're not impacting your lifestyle and not impacting your borrowing capacity moving forward, you can buy multiple properties and keep compounding. And the reason we like buy and hold is because you see these dips in here. If you're gonna buy something to flip it, you want to make sure that you're not buying something at the heat of the market up here, because you're going to try and sell it sometime later, a year later, and it's a lot of energy. You've got to pay tax on it, you've got to pay selling agents fees and all sorts of stuff. But if you can hold property, get creative, get it to cash flow so that it pays for itself and doesn't affect your lifestyle, you can accumulate, and the snowball effect of that is absolutely mind-blowing once it really starts to take effect. Just a couple of dates, I guess, in history here, guys. You can see just before 2000 here, we're having a big run in surge in property prices. Anyone got any idea what might have caused that?
Olympics.
Yep, good chance it's the Olympics. You can see a huge surge. It's really started to take off there, and we're in a very similar environment at the moment where we've got the Olympics coming to Queensland in 2032, and there is an immense amount of infrastructure spending that's going to take place here in and around Brisbane, Sunshine Coast, Gold Coast, all around up to Harvey Bay. There's events being held up there, so very good chance that we're going to have a similar run, or we already are having a similar run, which you'll see in the next couple of slides, but the run's going to continue, we believe, right up at least to 2032 and quite likely beyond. You can see in around this area here as well, 2008, 2009, we had a crash, and then it shot up again. We had the GFC A lot of people got really scared, which is fair enough. But then the flow-on effects of that was we had a run in property prices. 2020, COVID, same thing. There was fear in the market. The government pulled some levers, and it wasn't long after that we had a huge surge in property prices, and we're in the midst at the moment of potentially seeing something similar with what's happening overseas, where the price of fuel is going through the roof, and that affects us at the service station. But thinking further on, it also affects the cost of living. Everything, all our food needs to get delivered to supermarkets. Diesel, it all gets delivered there in trucks. All the farmers use diesel to generate and produce all our food to get it to the supermarkets. And so the cost of living quite likely is going to increase. And you know, we can't speculate what's going to happen. Who knows what Trump's going to do? But there's a good chance or possibility that something similar might happen in the near future. So I guess just knowing what happened after the GFC and what happened after COVID with property prices, just keep that in mind, I guess, when you're thinking about what you want to do in your future investments and what you want to do, you know, in the weeks and months ahead. Just going to get into some stats just quickly. So Southeast Queensland population growth and trends. So Southeast Queensland's reached 4 million people and is on track to reach 4.5 million by 2032. Nearly 5 million by mid-2030s. The population growth is accelerating, with Southeast Queensland growing by up to 2.2% over the last 5 years, faster than the national average of 1.5%. And overseas migration has been the key driver of population growth in Queensland. So you can see here, guys, 55,740 people have come from overseas, 21,595 net interstate migration, so all the southerners. Anyone here from Sydney or Melbourne? There is a couple. Yeah. So am I. I've been here 20 years, so I'm from the Sunshine Coast now. And then we've got the natural increase of 20,600. So still a lot of people moving here, moving to Southeast Queensland, moving to these numbers here are specific. These numbers here are specific to Queensland. So that's Queensland as a whole state. But you can, most of those numbers are in Southeast Queensland there. So more than 50% of growth is occurring outside Brisbane, signalling a shift out of metro and regional centres. So I think Gold Coast, Sunshine Coast, Toowoomba, Hervey Bay, those sorts of areas, and some of the bigger regional areas. So households are becoming smaller and more diverse, driving demand for different housing types, i.e. attached housing and smaller homes. So that's duplexes, secondary dwellings. We'll talk about that in a while, guys, so just leave that on your mind, that there's different forms of housing rather than just the standard 3-bed, 2-bath or 4-bed, 2-bath houses. The people who are looking for rental accommodation, it's changing. The actual fastest growing demographic of people needing rental accommodation is singles and couples. So building 3 and 4 bedroom homes doesn't suit the actual a lot of the people that are looking for rentals. So infrastructure investment and development ahead of 2032 Olympic Games is expected to support ongoing growth. So just a few numbers here on the last 5 years of people who've moved to these areas. Sunshine Coast, 47,500, Gold Coast, 68, Ipswich, 51, and Logan and Bow Desert, 60,000. Queensland new housing shortage. So the government has a target of 50,000 new homes per year. 2025, we had 39,500 approvals, 34,000 actually completed. Anyone got any idea why there's a, say, 6,000 different in that number?
Labour shortage.
Yep. Anyone else?
Because the councils are greedy.
councils are greedy. To a degree, look, labour shortage potentially. There's a lot of red tape, guys. So accepted development is a much faster approval process. There's basically a council assessment, or there's accepted development. And accepted development is where you go via a private certifier, and they can essentially approve the development on behalf of council. And I can speak from experience that there is a lot of approvals that council are approving, and the conditions that they're imposing are making the projects unfeasible. There's too many conditions in there that make you do a whole bunch of stuff. Some of the stuff that we've got coming out of council at the moment have over 100 conditions. And to meet all those conditions can be tricky, and it costs a lot of money. So I firmly believe that local councils are a big factor in why there is a disparity in those two numbers. The state government has actually done a couple of things to try and curb that and take some of the power away from local councils. So in 2022, late 2022, they brought in a state exemption for rooming accommodation that allowed us to build rooming accommodation statewide and without having to go to council for approval. It means we can do it via private certifier. It takes only a couple of months. The actual approval is very quick, but we have to do all the engineering and all that sort of stuff. But the actual lead up is very, very quick, and we can get them approved and get them built. Same thing with secondary dwellings. At the same time, the state government took away the power from local councils, and we can now rent secondary dwellings out to unrelated people. So at the time, if you had it's called a granny flat in your backyard, you could only rent it out to someone you're related to, so your mum or your daughter or something like that, your cousin. They took that away, and now it can be rented to unrelated people, so you can put it on the rental market and rent it out that way. And same thing, it's now accepted development, so anyone with a backyard that's big enough, there's a few things that we need to meet, but it allows us to build something small in the backyard there, 2 bedrooms, so 2 bedroom, 1 bathroom, 2 bedroom, 2 bathroom, and it's perfect for singles, it's perfect for young families, single parents, that sort of thing. So the state government brought both of those two things out in 2022 to try and lift the amount of housing and increase the amount of housing that was available to the market. And fast forward to 2025, and we're still that far short, 34,000, so we're still 16,000 dwellings short per year after the state government intervened. So I would hate to see what that number actually looked like if the state government did intervene, but unless more of the red tape is removed, that number is going to stay pretty close to where it is. So yeah, not a good thing. Same thing, vacancy rates. There's just not enough housing out there. The amount of people moving to South East Queensland far outstrips the amount of housing that we're providing. So it's across Queensland, we've got a 1% vacancy rate, which is extremely tight. You can see there, 0 to 2.5% is tight, health is 2.6 to 3.5, and weak is 3.6% plus. So we've been in an extremely tight rental market since COVID. And what we're talking about right now, you can see things aren't on the improve. If anything, they're going to get worse. We're not even getting close to the numbers of housing that we need to provide. So the rental market, you can see here, Greater Brisbane 1%, Ipswich 0.9, Logan 0.9. On average there, Sunshine Coast 1.2%. So you can see it's super tight, and rents are obviously rising because of that. So the impact of the Olympics. So property experts predict up to 50% property price growth in South East Queensland in the run-up to the Brisbane Olympics, driven by population growth, infrastructure investment, and supply constraints. So guys, if you buy $1 million property today, by the time the Olympics rolls around, they're suggesting that, or they're predicting that it's going to be worth 1.5 mil. So you're going to generate 500k of equity simply by holding that asset. So if you can apply something creative like we're talking about tonight to actually cash flow that asset, you'll be able to hold that through. So if you cash flow it, doesn't affect your lifestyle, you can hold it through the Olympics and end up with 500k of equity. 5-year growth. Since the Olympics announcement in 2021, Brisbane dwelling prices have risen by approximately 65 to 70% according to PropStrack. Those numbers are astonishing, guys. Like, that's really like a once in a lifetime numbers that we're talking there, and I think that that's going to continue leading up to the Olympics, just with all of the issues that we've got with supply. You can see over here, Sydney 2000 Olympics price growth over 5 years. So ending in 2001, so Sydney grew 88%. Melbourne, which I was really surprised about, grew 95%. And Griffith, which is regional New South Wales, grew 72%. So the growth that we're seeing now is a very, very good chance it's going to continue growing. We're going to see even more growth, which is just crazy. Brisbane delivered one of the strongest growth years in the country, with home values jumping 153,000 in 12 months. Guys, that's probably double the average wage in Australia at the moment. Surrounding regions such as Ipswich, Logan, Bow Desert, Moreton Bay, anywhere from 17.6 to 19.7, and the demand drivers, tight listings. There's not enough properties coming to market to meet the demand of buyers and the people that are wanting to buy homes. There's just not enough properties coming to market, and that's just pushing prices up even further. Rental price growth. So Brisbane, from 2021, Brisbane, $480 per week. The typical rent now in 2026, $730 to $740. Moreton Bay, very similar story, $460 up to close to $700. Sunshine Coast, $520 up to close to $800, and Gold Coast, $550 up to $900. So in a space of 5 years, rents have jumped 50%. So if you've been able to hold that asset, you've been able to buy something years ago, you've reaped the rewards of the growing rent, as well as also the growing equities. Whether it's growing as well, both are growing. So the housing market forecast. Just focus on Brisbane and Sunshine Coast for this. So they were originally forecasting Brisbane to grow 10 to 15%, and Sunshine Coast 10 to 15%. Due to, we've obviously had a couple of interest rate rises, they're now predicting that growth is going to be anywhere from 7 to 11 and 6 to 10% over the next 12 months. So still really, really, really strong price growth predicted in both those regions, Brisbane and Sunshine Coast, which, it's crazy. So what does this mean for the state of the Queensland housing market? So we've got tight listings, we've got shortage of new builds, we've got population growth, we have low housing affordability and major infrastructure projects leading up to the Olympics. That means rising house prices. On the other side, the rental market, we've got low supply of rental properties, population growth, rising rents, and major infrastructure projects, which equals a critically tight rental market. Guys, this is a perfect storm for a property investor. It's not great for the region as a whole. It means we've got a major housing shortage on our hands, but you guys as investors, you can take advantage of this and do something for yourselves, for your wealth, but you can also do a lot for the end user. If we can create more housing and get more housing out to the market, then it'll eventually bring rents down and make things more affordable. But while it's so scarce, it's just going to continue pushing and pushing. So some people might see us as greedy landlords, but we're actually trying to create more and more housing because the government isn't doing a very good job of it. So it really is up to us in this room and the mum and dad investors to get out there, and like I said, you can do really well for yourselves, but you can also help the rental market at the same time. We just put this together just to give a bit of a comparison of someone who saves their wage over a 5-year period versus someone who bought a property and reaped the rewards of 5 years of growth. And person A, the saver, they earn 100 grand a year, they save 20% of after-tax income, they've saved $15,400 for the year. So over 5 years, they've saved $77,210. So the outcome is they've increased their wealth by 77K. Flip that on its head, you got person B, who is the investor. They earn $100,000 a year. I'm just using round numbers here, guys. Purchased a $1 million Sunshine Coast property, used good debt to control a growth asset. Property value increased by 82% over that 5 years, which is what's done over the past 5 years. The equity gain, $820,000. So the outcome, overall wealth created over 5 years for the investor, $820K, versus the outcome for the person who saved their money of $77,000. So think about if you had more than one of these properties in your portfolio and how that could snowball in a very short period of time. And you know, we're talking about debt here. Used good debt to control a growth asset. If you want to build a portfolio, some of us in the room might have a big bucket of cash. We don't need to get into debt. You might just be able to go out and buy a property. But for anyone who is trying to build a portfolio, getting comfortable with debt and using good debt to your advantage is a really, really good tool to use. But you need to combine it with the cash flow. So if you've got too much debt and you don't have the cash flow to support it, you'll obviously come unstuck. But if you can use it to your advantage, you can really, really expedite your wealth and generate wealth at a lot faster pace. So we've got a few investment strategies that we're currently doing for ourselves and executing for our clients. I might hand over to Bianca. You can have a talk about that.
Have a drink of water.
Yeah.
Nice job. So as Joel was saying, we're really in this perfect storm at the moment, lots of different factors contributing. So right now, different strategies that are working for different investors depending on the stage of the journey that you're at. Initially, established homes are a really good foundational piece. So these are like your bread and butter for people that are just starting out. Making sure that you're purchasing in good quality areas, they're backed by good growth fundamentals and holding them for long term. So this is great for somebody that perhaps has limited cash or equity, they've got a certain amount of borrowing, but essentially to be able to move on and grow their portfolio, they're going to need some more equity or cash behind them. So really, really good like bread and butter just to get started. If that investor has a little bit extra cash, sometimes rather than just leaving it in its own merit, we might add some extra strategies. So that's when we might look at the one, if we go straight down the page, establish home and add a secondary dwelling. Joel was talking about it earlier with what we refer to as granny flat. If we can find an established home in that good growth area as well, that has the capacity to have a secondary dwelling, what this does is gives obviously the equity boost with the growth in the area combined with a dual income. So we create two income streams, we lift the yield, and this also supports the person when they want to recycle some of that equity, the property's grown, and they want to go and buy something else, they've actually got the cash flow there to support. So it's not changing their life, it's not replacing their income from day one, but it's supporting them in their journey to grow their portfolio. So yeah, sometimes it's just the one on its own, sometimes we combine the two together, and if we're getting really tricky, sometimes we do some cash flow strategies with that as well. But I'll touch on that afterwards. Moving on from there, for investors that maybe have a little bit more capital behind them and they're wanting to grow their portfolio quickly, duplexes are a great option for that. You essentially buy one block of land, but you can build two dwellings. And the advantage of this is you get dual income stream. and you've got options at the end. You can actually strata title and sell them individually, so they can act as independent houses. If your long-term goal is to hold the property, it's probably, and again it comes down to what the goal is, you might want to leave it on one title. You pay one lot of rates, one lot of water, until you're ready to either strata title and extract the equity, strata title, sell one, sell both, depending on the strategy. But it's a really good, flexible option for people that are wanting to build their portfolio quickly, get some equity uplift. We'll take you through some case studies afterwards that will show you immediate uplift after strata titling, and how that can basically catapult you into your next project immediately afterwards. And then from there we move into our rooming houses. So these are the high yielding assets, great for established investors. Is anyone not familiar with rooming houses or rooming accom? No? All heard of it before? So essentially from the outside it looks like a house, like the house next door, but inside it's usually up to 5 individual micro apartments, so to speak. What this does is create 5 income streams, back to where Joel was talking earlier in terms of the rental market, the singles and the couples. Sometimes we'll do a 3-bedder, a 4-bedder, and that allows us to have couples in those rooms. So really great. We usually end up with anywhere from an 8 to a 12% gross return, depending on where the property is, what the rents are, total project costs, but really great. The biggest change for rooming houses lately have been probably in the last 9 to 12 months. We did have lenders that were offering an 80% LVR, and up until that point, and then they actually pulled funding, the lenders, for that. So at the moment, lending for rooming houses specifically it's limited for construction, so new builds. It gets a bit trickier.
Yeah, guys, rooming houses, for anyone that's walked through, we've done a couple of open homes with them. They're pretty sexy, they're good, they get really good yields, but lending is challenging for them. And like Bianca said, it used to be easier, but it has become a little bit challenging. Established homes, buy and hold, and adding a secondary dwelling, it's not sexy, but they're good foundational projects. And if you're buying $1 million property and it's you're in a 7% growth rate, you're making 70 grand just in a year, just from holding that. So the part of building a portfolio is really tapping into the bank and utilising the bank's money. And for anyone who's in the early stages of building their portfolio, we have to stick with the mainstream lending. So we can just go and build, add some value, and we can go to any old lender out there, CBA, Macquarie, NAB, we can refinance, extract some equity. It's not that easy when we come to rooming houses because we only have a few lenders that'll do it. It's the construction phase that's the problem. So once they're built, we've got some lenders that will refi and we can extract equity that way, but it's just the front end of the construction phase. So because the banks aren't playing ball with us there, the rooming houses, as good a yield as they're giving, they're really just open and they're there for the more experienced investors.
Yeah, someone that's more established has the capital behind them to get through that construction period, and then if they do want to refinance, they've got more options available to them, and also obviously move them into the next part of their investing journey. Yeah,
I spoke about before too, and the rental demographics changing. People who are looking for rental properties, it's the biggest growing demographic is singles and couples, and so if we can build smaller, smarter homes to accommodate that, you're going to be far better off. So we've got the established home and build a secondary dwelling. It might be anywhere from 60, anywhere up to 90 square metres in some councils. But say 60 square metres, that's perfect for single or a couple or single parent, something like that. And then the rooming houses, we're able to build 5 homes for people at the same time someone can build a 4-bedroom home. So we've got 5 individual areas that can accommodate single people, and what that does is it gets those single people out of those 3 4-bedroom homes, and it opens up the 3 and 4-bedroom homes for the families and people who have families. So it's a lot faster way to create housing. and it's just one of the strategies that we can utilise and deploy so that it's also good for the investor.
Yeah, absolutely. So now we're going to get into some case studies, and what we've chosen to do because we're Sunshine Coast tonight, we've pretty much picked Sunshine Coast projects past and also ones that we're currently going through. So you can see, obviously prices are changing. This particular one, the goal for the client, they wanted to start building their portfolio. They had their own home, but they hadn't invested before. Comfortable investing on the Sunshine Coast because this is where they were based. And essentially they wanted to start building their portfolio, but also geared toward cash flow. So for them, we helped them basically decide what their goals are and deploy the strategy. So we've purchased an existing home below market value in a high growth area, and then we use the rooming accommodation strategy over the top. So initially when we purchased, it was $730,000. That was purchased in February 24. We did a renovation and converted it into 3 micro apartments. So it was pretty run down the place as it was. So cosmetic reno plus adding, it was 3 bed, 1 bath, 1 car. We ended up adding, ended up being 3 bed, 3 bath rooming accommodation by the end. So total cost for the investor were $883,000. Recent comparable sale at the end of last year was $980, just on the same street, and essentially the rental income after we were finished was $1,300. A standard property in the area when it was purchased was about $550 per week. So really increased the rental income for the investor. The result, initially we negotiated $30,000 off the advertised price, which was really good for the client. Took the rent from $550 per week up to $1,300 during the renovation. Then total investment, $883, and now, well, end of last year, properties were selling for $980 up the road. So an increase of $97,000 in just 20 months, or just under $5,000 per month. Not too bad of equity and cash flow. This is something that we're currently doing for a client. So we recently purchased, it's just about to settle. Again, a young investor wanting to build their portfolio. We assisted them to go through their goals and work out what the right approach would be for them. So purchase established home and add a secondary dwelling. We picked this up for $721,000 with the build cost of the secondary dwelling, stamp duty, legal fees, our buyer's agency fee. Total project costs are sitting at just over $1,073,000. Forecasted gross rental yield 5.37, and once it's finished, once the 2 dwellings are rented out, it'll be about $1,130 per week. We haven't done if there's if there's 80% LVR, it gets a bit too confusing, but after annual expenses, if there was no mortgage, this would cash flow $40,000 per annum. So that's based on comparable rentals in the area at the moment. We expect this to be finished in the next 6 to 9 months. Obviously, we've just been through the acquisition period, and then we will move into the construction phase. Duplex, do you want to do this one?
Sure. So this is a duplex here on the Sunshine Coast. 2 3 bed, 3 bath, 2 car space dwellings. Total development cost 1.145. The client here wanted to extract as much equity as they could, so they strata titled, and the valuation post strata titling was 1.37. Rental income 650 a side, so it was a gross yield of just under 6%. This was primarily a growth strategy. Obviously, we've got the duplex. There's bonuses of building a duplex, that it's more feasible cost in terms of overall cost. It costs less to build a duplex than it would to build 2 separate houses, but you get the second title out of it. So there's equity uplift there.
And then a lot of stamp duty.
Yeah, less stamp duty. So the result, client had already achieved an equity uplift of approximately $2,225,000. Placing in a strong position to continue expanding his portfolio.
This one is one that the client already owned. So as well as sourcing property for people, sometimes we have investors come to us that already own sites. This is one the client already owned when they approached us and wanted help to see basically how they could maximise the site potential. They wanted to create some equity, hold as much as they can, but they wanted to reduce their risk along the way. So often with sites, there's multiple different outcomes that you can have. You know, people talk about the highest and best use, but just because you can doesn't mean you should. So it always comes back to, you know, what is the client's goals, what's their financial capacity, what's their risk appetite, what's the council doing. All these things, you know, play a big part into the decision making on what someone should or shouldn't do on their site. So ultimately the client decided to, it's an existing house. So, do you have your clicker? Oh,
Okay.
oh, thank you. Is it working?
Yeah, it just takes a bit.
Okay. So on the right at the top there, lot, is it working? Oh, there we go. Here, this is the existing house. The street frontage is here, and what we've helped the client do is essentially subdivide what was one big lot with a house at the front into 3 lots. So lot 1, lot 2 and lot 3. And combined with that, we've got approval for duplex on those 2 back blocks. So that was the strategy that we applied. The status of this is currently underway. So we've received the development approval for this, pending commencement of the subdivision works, and then the construction of the duplexes. So ultimately the client wanted options. They wanted to reduce their risk. So once the subdivision's executed, their plan at this stage is to sell this house and then to construct the duplexes. They've got options then. They can potentially strata title each of them, sell them all. They'll have some great equity uplift. They want to hold. They'll probably leave them on 1 title each, hold them, enjoy the cash flow. If they ever need to sell, yeah, they've essentially got another 4 assets they can sell to do that. You know, a site like this, typically you might also be able to do townhouses, and often people get excited about bigger developments. Staging it like this, there's a number of reasons why they would have chosen to do that, and I'll let you speak to that. Like, you're a big advocate for staging things.
Yeah, just if you can stage things and minimise your risk, I'm always a big fan of that. Also, if you can retain an existing house, there's also generally a lot of good reasons why you might do that. One, you generally won't pay GST on the sale of an existing dwelling. And secondly, if the house can be saved, knocking it over, you're just knocking over a perfectly good asset to replace it with another asset. So it doesn't always, the numbers don't always work out like that, like depending on what area you're in. But quite often, you're a step ahead already if you can retain that existing house. And we're able to with this one. I think they bought this site for 950K, something like that. And they've just done a little cosmetic reno to that house, and it's going to be going on the market. It's probably going to sell in the mid to high 8s.
Just for the house?
Just for the house, yeah. So subdivision works are about 400K for this one. So overall, they're going to get a couple of blocks of land there. Once we factor in all the costs, the holding costs, and all the costs of the council contributions and everything that goes along with development, they're going to make a nice little pretty penny on the 2 blocks, and then also adding another stage for the duplexes, the construction and the strata titling. So they're stacking multiple things, multiple strategies with this one. It sounds really sexy, and look, you can make a lot of money, but it does take a lot of time and a lot of energy. So generally, through the buyer's agency, we will generally try and stick to acceptable outcomes where we don't have to go to a full council application like we've done with this. But he brought us this site. He wanted a hand to help develop it. So that's what we've been able to do for him.
Yeah. Oh, what we've just got at the bottom there, we haven't gone into the full detail of the subdivision just because it's still going. But in terms of the duplex build, down here you can see this is the 2 duplexes out the back, so this is the shared driveway, and you've got 1 duplex here and 1 here. The cost to do one, basically we're basing this on what the land value would be in the area plus the construction costs at the moment. So it'll end up being a 3-bed, 3-bath, 2-car duplex per side, and total project costs for this will be around 1.3. anticipated value upon completion in the current market. By the time it's finished, obviously this is going to change. But yeah, we're looking at about 1.55, 775 per side of the duplex, giving a 6% gross yield just on one duplex. So again, stacking multiple strategies, but if you're just looking at one duplex on its own, still a really good outcome for the investor. Some rooming house case studies. So this is something that we completed for a client last year, finished April last year. The client came to us, they were looking for a strong asset to move into their retirement. They did this actually in their super fund, and it was purchased cash. So the goal for them was cash flow. They were in an established phase of their life where they were looking for an asset that was really going to offer something like this. We helped them source and develop a 5-bed, 5-bath rooming house. It also had 5 cars, so you'll see, like we talked about before, rooming house probably looked very different to what people's initial perception is of them, but it just looks like a normal house from the front. Double car garage, and it also has enough car spaces for 5 people. So 2 there, obviously. Is this 2 or 3 here?
It's 2 there.
2 there and 1 over, yeah, and 1 over there. So total project cost for this at the time was $843,000. This was total spend, so land, stamp duty, construction costs, furniture package, buyer's agency fee, all the costs. So basically all in for $843 for the investor. Project time frame was 12 months, and they ended up with a 12.5% gross yield. Essentially, if we look here, they're bringing in $2,100 a week for this particular property, with all 5 rented basically as soon as it hit the market. None of them in vacant since, which is really common for all our rooming houses that we do for clients. Unencumbered, so because they own this outright, there's no mortgage, they're essentially getting $82,000 of cash flow per annum after their costs.
Just go back for a sec, can you?
Yep.
So guys, this was a cash deal in their super fund. They had enough money in their super fund to do this in cash, and now they're netting, so after expenses, they're netting $82,700 every year in their bank. That's after expenses. Who would like $82,000 a year coming in from one property? Only 2. There's only 2 people in this room that would like $82,000 a year. Wow. It was a hard market. The other thing, we picked this land up. So we finished this last year. This land was $260K. That's what we paid for that land. If I was to go and buy a block of land in this area right now, we'd be paying over $400. That's what's happened in the market just in that time. It's probably been 18 months or so since we picked this site up. The market's moved, it's shifted a long way.
This is another rooming house. This one's on the Sunshine Coast, so it was just finished, where are we? Late last year, October 25. Again, somebody, as a really established investor, they've got a broad portfolio. They essentially just wanted someone to handle it for them. And they're not retired yet, but they are heading into that stage of their life. So essentially they came to see us, and we helped them source and build another 5-bed, 5-bath, 5-car rooming house. This one, based on the Sunshine Coast, total costs were $1.16. And again, that's total costs all in: land, stamp duty, construction costs, furniture package, our fees, the whole lot. That was 12 months from basically coming on board as a client, acquisition period, going through the building approval phase, and construction to handover. And the result, just under a 10% gross yield, 9.74. Again, they're generating $2,220 per week, or $113,000 per annum with a week's vacancy. So again, unencumbered, so if there was no loan on this after annual general expenses, so that is your property manager's fees, water, rates, insurance, all your utilities, essentially $89,000 per annum of cash flow if it was unencumbered without a loan. So again, great outcome, really good cash flow, and again, only just completed last year. I think they purchased the land at the start of 2025, and like again, to pick up land in that area now. Do you remember how much they paid off the top of your head? No. Anyway, again, there's been a lot of growth in that past sort of 12, 18 months since we picked it up. So there's just a few case studies that we can show you. We can go through multiple different case studies, different areas. We've chosen to sort of stick around the Sunshine Coast because that's where we are. Essentially, you're all here because you're interested in property, probably for different reasons. If you are interested in building a portfolio, we just want to run you through kind of what the high-level steps are, again, depending on what stage of the journey you're at, but you might find these things really helpful, and yeah, if we can point you in the right direction, more than happy to. Oh, you can do it.
Right. So firstly, get clear on your goals, guys. What do you want to get out of building a portfolio? Is it to get yourself out of work? Is it to put your kids through school? Is it to travel the world? Whatever it might be, you need to get clear on what you're trying to achieve. Chat to a mortgage broker, get a preliminary assessment, see what you can borrow. You might find that you're not in a position at the time. They'll be able to give you the steps of what you need to do and what you need to make in order to be able to borrow money.
And that doesn't mean a full pre-approval. I think sometimes people think they have to go through the full pre-approval. You can get like a preliminary assessment just to give you a guide, and that really is the starting block. Like if you don't know what you can borrow, like you literally can't move forward. Like you could be looking at properties that are within your reach or thinking they're within your reach and they're not, and vice versa. You know, you might have more equity than you think, and you're looking for more equity strategies when you actually need to do a cash flow, or vice versa. So that finance piece is really important. So working with a good broker that understands what your goals are as well, also really important.
Research and due diligence. You know, there's a lot of things that go into making a purchase and making sure it's a good purchase. So you need to do your research, all your due diligence. Get a good team of professionals to support your investing journey. Guys, we've got a lot of our team in this room at the moment, from property managers, solicitors. So we've got our team from Echo as well. So guys, if you need someone, if you don't have someone in your corner, just reach out to us. We can put you in touch with any one of our team. Advice around purchasing entities. Again, we can't give you that advice, and depending on where you're at and how you're structured, it will change. Like generally speaking, we kind of encourage people to purchase in a trust structure with a corporate trustee, but that's not what everyone should be doing. Like our next purchase, Bianca and mine, is going to be in a company for tax reasons, and so everyone's situation is different, and so you just need to get the right advice. And again, we can put you in to chat to the right people to give you that advice, and we can bounce ideas off us, because you might get different advice from your accountant, and you might get different advice from your solicitor. And you kind of need to figure out which one's going to be right for me. So we're always here to bounce that off. Getting comfortable with good debt, guys. It's a tool. It's a tool that you can use, and when you start to understand it, you can start to understand the power of what good debt can do for your overall wealth. You just need to get comfortable with it, and depending on your risk tolerance will probably depend on how comfortable you actually get with that. And moving on from that, paying today's debt off with tomorrow's money. We looked at the chart at the start, guys. You could buy property for 200 grand, 20, 30 years ago. That debt if you don't borrow against that property, that debt stays the same. It's still 200 grand, but moving forward 20 years, instead of it renting for $200 a week, it's now renting for $1,000 a week. So you're paying yesterday's debt off with tomorrow's money, and that's the power of inflation. And we've seen inflation ramp up quite a bit since 2020, and it's ramping up a little bit at the moment, hence why they've raised interest rates. So inflation is also a tool to help you create more wealth.
Oh yeah. So key takeaways from tonight before we get stuck into some Q&A. Obviously, Southeast Queensland fundamentals remain strong. We've got population growth with undersupply, tight rentals, and resilient prices. We've got rental growth is going up at a crazy rate. Supply isn't catching up. Obviously, new housing delivery is well below what we need. And obviously the demand that's currently here and what's still coming. Ultimately, with the forecast, we may see some slowing, but it's not going to stop. It's like we looked at that graph at the start, even with the ebbs and the flows, it's trending in one direction. Even with the uncertainty in the market at the moment, you know, it may slow, but it won't stop. So strategy beats timing every time. So wealth is built through the right asset, the right structure, and long-term holding, as Joel talked about. Timing the market and selling costs, you know, selling assets costs money. So if your goal is long-term wealth, making sure you're buying the right assets in the right structures with the right advice in the right areas and the right strategy, you know, it's a recipe. And sometimes people get lucky, and then sometimes the people that get lucky are actually very strategic. So just be nice and clear about what it is that you want to get out of your portfolio.
I think I just want to reiterate that we're obviously talking about investment strategies and building wealth for ourselves, and we're all here in the room. We all, you know, want to create more wealth for ourselves, but you really can do well for other people at the same time. And like I said, we are in a huge housing shortage, and it is up to us in the room to create more housing. The government's doing a terrible job at it, so it is up to us, the mum and dad investors, to get out there and actually create that housing. And the more that we can create, the more supply we get out there, and it will eventually bring prices down. So yeah, get out there, get into the market, guys.